I've been trading more than 14 years and I've been using support and resistance for all those years. And in this video, I'm going to show you a special support and resistance concept, which is referred to as accumulation and distribution. It also falls into the category of liquidity zones. And it's very, very important that we are aware of this because this is what's going on behind the scenes. This is how the big players, the smart money is driving the markets. And I will show you exactly how to use it in your trading to improve your chart reading and how to find the best trades using those concepts. As always, we are starting with the very foundation, with the basics of accumulation and distribution theory. I will show you what it is, how to use it, and then step by step throughout this video, we will build on this knowledge so that by the end of this video, you will have a very profound and deep understanding of all the important things that you need to know. When we look at a price chart, we can see those different stages that every price chart is made up of. We have ranges like here, we have downtrends, we have reversal structures where trends turn, and then we have uptrending trending days as well. And accumulation and distribution theory mainly focuses on those turning points where the powers are shifting between a bear market and a bull market. And especially in Forex or stocks, which are huge international financial markets, where there's billions and trillions of dollars being invested every single day, it takes a lot of power to reverse a trend. When we go from a downtrend to an uptrend, something very significant must have happened here. And accumulation and distribution theory is focusing on those turning points because there is where the most of the transaction volume is happening, where a lot of things are taking place, and we can then use this knowledge to our advantage going forward. So classically, when we talk about a downtrend reversing into an uptrend, at the bottom we are looking for a accumulation zone, and this is referred to as accumulation. At the top, when we are looking for an uptrend reversing into a downtrend, we are talking about a distribution zone. And there are many ways how we can use it. And one of the first ones, a very classic one, is that once we have identified that the market is going from an uptrend in a distribution, a sideways range, and then the market is exiting this distribution zone, very often with an initial break and retest, the market is coming back afterwards. So we are moving away from the distribution zone, and then we are very often with very strong force moving back into the level. Then what we are going to do here is we're going to drop to a lower time frame at the point where the market is moving into the zone, and then looking for trend continuations. Some people may have heard about Elliott wave or general wave theory. And when we talk about wave theory, this would fit into a wave 2 to wave 3 reversal. So when the market is exiting a distribution sideways range, we have our first initial, also sometimes referred to as impulsive trend wave. In Elliott wave theory, this would be considered wave 1. Then the first corrective wave is wave 2. Very important in wave theory is that the impulsive wave, so wave 1, wave 3, wave 5, are often and have to be longer than those corrective waves. So you can see wave 1 compared to wave 2. Wave 1 is much, much longer, whereas wave 2 is shorter. And this has to be the case because only then will we get the formation of lower lows and lower highs. So you can see, whereas here we have the top of the previous uptrend, now we are looking at a potential wave 2, and the highest point of wave 2 has to be lower than the initial reversal point. And then what the idea behind this is that we are looking for the market to dip back into the distribution zone, pick up more selling momentum, and reverse this wave 2 corrective wave into the next impulsive wave, so wave 3 in Elliott wave theory. So now at this point, what we're going to do is drop to a lower time frame and observe micro price structure. And you can see we are going now from the higher time frame 1 hour to the lower time frame 15 minute. We could even go to as low as the 5-minute chart. So this could be considered a day trading approach, for example. And on the 15-minute, you can see the market dipped into the distribution zone here, moved away from it, made another run higher. However, you can see we have lower highs. Very important. Lower highs indicate that the bullish power, the people who wanted to buy, were not able to continue the price higher. So the sellers came in earlier and earlier to drive the price down. That's a very important market tell. To the downside, we can see that the market is giving us this nice support area. So one trading plan could be we're looking for a break and a retest of this structure and then looking for continuations into the bigger picture downtrend wave 3, as I said. You can see what we have now is a dirty retest. The dirty retest I explained in one of my recent videos, so you can go to my YouTube channel, just go to the recent videos and search for dirty retest, which is also a very great day trading strategy, so make sure to check that out. And you can see after the market broke out, we came back into the structure and we're moving away from it. So at this point, you could consider this a trade entry, for example. And this is beautiful because what we are seeing now is we are having our retest here. So in the bigger picture, the big time frame, the higher time frame, we have a breakout and a retest. And on the lower time frame, we are seeing the same on a micro scale. We have a break and a retest. So you can see we are really nicely combining the two time frames together to form a great way to enter trades. And you can see the market eventually broke lower and then started here this wave 3, which we observed in the higher time frame. And when we zoom back out, you can see this is where the market dipped back into the distribution zone and then moved lower. And this is how you could use generally classic accumulation distribution zones. When we follow the price action a little bit longer, you can see the market came back to this lower accumulation zone where the market turned from a downtrend to an uptrend. And this is the point where you would now get to a lower time frame again and look for bullish waves. So we are looking for a reversal. This downtrend here that has been taking place has a good chance of maybe ending, but sometimes even completely reversing. And using supply and demand, accumulation, distribution concepts, we can use it to our advantage. So we're dropping again to a lower 15-minute time frame. So as long as the market gets close to this accumulation zone that we drew and is showing you a reaction in form of the market slowing down, maybe giving you a nice price pattern, that's your clue to drop to a lower time frame. We don't necessarily have to see the market dip into the zone, although there are some really interesting concepts later in this video where we're going to show you how the market over time is sometimes eating up the accumulation and distribution and pushing into such zones deeper and deeper, and how you can use that for a dedicated strategy. So make sure to stick around because that's very common and it's something that a lot of traders struggle with. So that's going to be very interesting later on. So in this case, what we are going to do is, first of all, we do nothing very important. We don't want to trade in ranges. So we want to make sure that the market is breaking out of it. And then you can see the market broke out. It's coming back into it. So again, interestingly, the market is fractal in its nature. And this means that what you see on the higher time frame is also going to repeat on the lower time frame. So on the higher time frame, you can see we have downtrends, accumulation, breakouts, trends, distributions, breakout, retest, and all of that. And on the lower time frame, the same thing happens as well, just on a lower time frame. We have a downtrend, we have a distribution or accumulation in this example, with a breakout, a potential retest, and then we are waiting for a follow through. So this is what the fractal nature of the market means. So at this point, you can see when the market dips into the previous breakout area, or on a lower time frame, we could also say our 15-minute accumulation. Then we could even go to another lower time frame, or we stay on the same time frame and look for patterns. I always recommend to wait for a pattern to emerge around a potential entry point, because patterns are a little bit more of an objective way to get into a trade. So a pattern uses a trend line, horizontal support and resistance, and if we have those concepts, they often allow us to find more objective entries. So here you can see the market presented a little bit afterwards a nice trend line pattern. You could say it's a flag pattern, a triangle, and then on the breakout, this is your clue. You can see here we have a lower high as well, very dirty retest as well, and then afterwards the market picked up. Another very interesting thing what you could have done is at this point when you see the market is in the zone and decelerating, and I made specific videos on my YouTube channel about deceleration as well, so make sure to check that. At this point you could even drop to a lower time frame, 5 minute, 1 minute, and on the lower time frame you will see that those two little deceleration candles will look very similar to what we are seeing here. So you can really take this to another extreme. You start on the 1 hour, you look for those zones, you wait for the market to get back there, you drop one time frame lower, you wait for the breakout, you wait for the retest on this time frame. Now you would drop to the lowest time frame, and there you could see this little move here would have been a very nice break and retest pattern. So there are many options, and obviously this is just an introduction video, although we're going to go much deeper now with the following trades. I hope it gives you some ideas how you can use those concepts in different ways. So this was already a quite interesting start, and now let's keep building on our knowledge. So in the second example, we're going to take a look at an accumulation and distribution reversal. So again, very similar. You can see the market is in a downtrend, and then here at the bottom it has an accumulation zone, and there are a few specific signs that you could look for accumulation and distribution zones. First of all, usually they come with a double top, triple top, or in this case double or triple bottom. Very often they have those fake outs. Some traders refer to them as springs, where you can see the market push through it and immediately reverse back. Very often they have a very nicely well-defined horizontal level, and those help us in determining the quality and also be a little bit more objective on our accumulation zone. So now you can see the market has afterwards started trading higher, and the trend that emerges afterwards, that's really our signal that there is something happening. And very often you have those immediate break and retests, and if you miss them, don't worry, that's not the point of the accumulation and distribution theory. What you want to see is the market trade away from it, and we need to really see that trend emerge after the breakout here, because only if the trend emerges afterwards, we know that there's at the origin there is the accumulation and the distribution zone, because the idea is that we want to find those areas where the market has really turned around from one trend direction into the other. And so don't worry, you don't need to be fast, you don't need to get into the first break and retest, not necessary at all, but we really want to find those strong reversal points. And then we just extend it going forward, and you can see the market dipped into this. At this point, you can see we have no real deceleration. The market is just very, very aggressively selling into this zone. And just because the market is hitting such a previous accumulation and distribution zone, it doesn't mean you should automatically get into a trade. It's always recommended to wait for a sign that the market is actually pausing here, that the trend that has been going on previously is slowing down. And you can see this happen afterwards very clearly. And this is the great thing about this theory, is that you don't need to be super fast, and you don't have to suffer from FOMO. Usually you have quite a lot of time to really start to noticing the initial zone, then you have time for the market to get back to it, and then you have time for the pattern to emerge until you see some signs that the market is slowing down. At this point, we could drop to a lower time frame, or you could just trade it directly on this time frame. You can see we get this very nice pattern here. The market is rounding off. You can see that very nicely. To the upside, now we don't have a lot of room to the upside, because here you can see we are running into the next very strong support level or resistance if the market reaches it from underneath. So although there are some good signs, and there's probably a high probability that the market is going to find some support in the accumulation zone, and if it can break out of the pattern, there's a very high chance that the market will reverse into this. And you can see this is what happens. The market broke out and reversed into it very strongly. However, the market also reversed away from it very strongly. And if you're in such a trade and you can see the market is reversing back away from it very strongly and then coming back into it, if the market doesn't break above it, it's usually a good idea to get out of it, because first of all, there are a lot of negative confluence factors. The big level here, the market has already given you here the double top, and at this point it's better to just get out of the trade and move on, wait for the next opportunity. You can see afterwards, this is where we left off, you can see we have a double pin bar, which is also referred to as a tweezer, and the tweezer should be your last ultimate sign that it's time to get out of the trade. And you can see the market afterwards move back into the bigger accumulation zone. Just a quick reminder, it's this one here that I'm talking about. So the market is back into it, and now it's breaking out of it to the downside. So distribution in this case, it connects the downtrend with the potential next downtrend. You can see this is exactly what happened. We have a downtrend, distribution, and a downtrend. So sometimes distribution accumulation zones can occur in different contexts. What is important about it is that we are looking for the connection. So the distribution and accumulation zones, they always connect trending phases. So whereas in the beginning we are talking about a downtrend connected an uptrend, In this example, we have a downtrend connection with another downtrend, so a continuation. It's also important if there is a strong breakout and a strong initial move, usually it is pointing towards a more valid and a stronger accumulation zone. So in this case, you can see we are looking at a different concepts, but the idea is the same. We wait for the market to trade away from it, then come back to it. At this point, what we're going to do is go to a lower time frame, or we wait for signals there. You can see afterwards, the market really collapsed. At this point, this is a deceleration candle. What you could be doing, drop to a lower time frame. Here you could have drawn your trend line in, wait for a trend line breakout, and then trade the continuation. So this is a very important example because it helps you understand that there are different types of accumulation and distribution zones. It also helps you understand when to get out of a trade, when to look for a new trading opportunity. And I find it always very helpful to stay flexible in your mind, because a lot of traders get married to a trading idea too soon, and then they are locked into only one direction. If you're only aware of the accumulation zone and you really only see that and you think the market has to go up, you're going to ignore signals and signs that the market is not able to reach your ultimate target. Although you could have probably gotten out a little bit of a profit here, a lot of traders will be too stubborn, hold onto it, miss the double tweezer at the resistance area, then have a loss,